Today was a punishingly heavy day for the NASDAQ. To understand why, we have to look past the surface-level noise and find the verified numbers. Geopolitical fear drove the primary macro narrative. Reports regarding the industrial infrastructure of Iran's Karg Island fueled specific threats to global oil supplies and the stability of the Strait of Hormuz. Adding to that pressure, today was a quarterly derivatives expiration day, or triple witching. This is a scheduled event where major institutions must roll or close out massive positions, which historically triggers high volatility and volume across the session. These external geopolitical shocks and internal structural requirements created a combined weight that overwhelmed the market's standard defensive levels from the opening bell. Yesterday's NDX close at 24,355.28 established a ceiling the market failed to reclaim. Below that, yesterday's low sat at 24,100.88, marking the critical support floor. Macro weight pushed the index aggressively through this floor, crashing to a verified daily close of 24,041.97. Breaking this floor and settling near the absolute low of the day indicates that sellers maintained control throughout the session without allowing buyers to reclaim any significant ground. This highlights a liquidity pool, a cluster of stop-loss orders typically placed below a prior day floor like 24,100.88. When the index crossed this threshold, it triggered those resting sell orders, accelerating downward momentum as the market searched for new buyers. We can frame this range by splitting it in half. The upper half is the premium, where prices are relatively expensive, and the lower half is the discount, where they are relatively cheap. Today's close at $24,041.97 confirms the market spent the entire day delivering price into that deep discount territory. Sweeping through sell-side liquidity without triggering a meaningful bounce indicates a structural breakdown in the trend, rather than a minor intraday fluctuation. The tech sector's move was mirrored by adjacent asset classes, reacting to risks in the Strait of Hormuz, a critical global shipping choke point. As these geopolitical tensions spiked, global oil prices surged in tandem, reflecting the market's anxiety over energy supply chains. Rising energy costs directly trigger inflation fears. Higher inflation expectations mathematically compress the valuations of growth-heavy tech stocks, adding further fundamental weight to the NASDAQ. The NASDAQ's decline was driven by this outside pressure, as the broader market adjusted to the heightened risks in the energy sector. Moving from macro theory to practical application requires a mechanical blueprint for trading these broken floor scenarios. First, wait for a definitive break of the 24,100.88 floor. Catching a falling knife leads to losses. Second, be patient. Wait for price to test the broken floor from below. When old support acts as resistance, you have a high probability entry. Every trade must include a strict tight stop loss. On days driven by headlines and quarterly expirations, sudden reversals can happen in seconds. Utilizing a predefined mechanical system provides a framework to manage risk on chaotic days, helping to navigate the volatility that often overwhelms emotional decision-making. Maintaining this level of discipline during high volatility sessions is one of the most difficult challenges for traders working in isolation. One-on-one coaching helps bridge the gap between identifying levels on a chart and having the psychological discipline to execute a plan in real time. Professional mentorship allows you to build a customized plan tailored to your account size and specific risk tolerance. Sustainable trading relies on trusting verified facts over social media narratives. Visit our site to learn how to build your professional edge. This video is for educational purposes only.